I've been working in data and analytics for over 10 years, and I've used that knowledge to find sensible investment strategies that consistently work over the long term. And what I've learnt can be summarised in the rules I'll set out in this video. So if you want to start investing this year, here's my advice for finding low risk but high reward stocks. Number 1, don't try to find value stocks. When most people start investing, they're drawn towards famous and successful investors, and there's no one more famous or successful in the investing world than Warren Buffett, who's generally known for value investing. As a result, beginner investors often get drawn into thinking that value investing is a really good idea. And people will often cite Buffett's famous cigar butt strategy, where he will find stocks that were out of favour with the market and therefore priced really low. Often the companies were valued less than the actual net value of the assets they owned, which meant in theory that these businesses were valued so low, you'd be able to buy the whole company, then sell its assets, use that money from selling its assets to clear all the debts, and the money left over would still be more than the initial purchase price of the business. Now, Buffett wouldn't buy and sell the whole business. He'd just wait for the market to realise that these stocks were severely undervalued, eventually resulting in a correction. The share price went up, and then he sold his shares. It's a strategy based very heavily on metrics like the price to book ratio, which is the share price versus the net asset value of the company, and the price to earnings, which is the share price versus the amount of profit the company makes. It was a great strategy. It worked very well at the time, but he did it back in the 50s. That's over 70 years ago now. It's not a good strategy anymore. It's definitely not a good strategy for new investors, and it's a strategy Warren Buffett himself hasn't used since the 50s. The problem is, new investors don't realise this until they've already started investing. They've read all these articles on how to find undervalued stocks, filled their portfolio with super undervalued contrarian companies, and then 12 months in, they end up down on all of their investments. And then they realise all they did was buy shares in a bunch of dying companies. Investing is not about finding traditional value stocks, and the rest of this video will show you what you should be doing instead. Number 2, high risk, high reward is a stupid idea. I hate this phrase. It's a phrase that solely belongs in the realms of gambling, and investing should not be gambling. If you put all your money on 15 at the roulette table, that's a high risk, high reward situation, but it's not a situation in which you're very likely to win. And investing isn't a casino. With investing, we can tilt the odds significantly in our favour. So that's exactly what we should do. If you take just one thing away from this video, I would be delighted if it was this point. You do not want to fill your portfolio with high risk, high reward investments. That is a recipe for disaster. Because what we actually want to do is create a portfolio full of low risk but high reward investments. Which is obvious when you say it out loud, isn't it? For some reason, people don't think that low risk, high reward is an option. But it totally is. And the rules I'll set out in this video are going to show you exactly how to find low risk, high reward stocks. Number 3 is to find businesses that will grow, and it's actually not very hard to do. When you're investing, the primary thing you're trying to do is to find businesses that will grow. You very simply want to find businesses that are likely to sell more things in the future than they're selling today. That's one of the big reasons we don't want to look for value stocks, because often the lowest valued businesses are the ones whose sales are actually decreasing. Their business is getting smaller, whereas we want to find businesses that are getting bigger. Again, it's pretty obvious when you say it out loud, but so many people make investing so much more complicated than it actually needs to be. And they take the totally wrong approach to finding businesses that are very likely to grow. Because the answer to finding high growth companies is actually very simple. One of the very best indicators for finding businesses that will experience growth in the future is to find businesses that have experienced historical growth. And one of the very best metrics for that is a company's revenue or sales growth over the previous 5 years. I've done my own research on the impact historical revenue growth has on future share price growth, and I found there is a correlation between the previous 5-year revenue growth and the following 5-year share price growth. In fact, if you'd taken the USA's top 100 companies in 2019 and filtered them down by only those who had experienced a previous 5-year revenue growth of 50% or more, your average share price increase from those investments since 2019 to now would have been 419%. The data is very clear on this, but it's also just common sense when you think about it. If a business has already figured out how to increase its sales, it's much more likely to be able to continue increasing its sales than a business who's been stagnant for the last 5 years. A company's history always tells us a lot about its future, but these high growth companies can come with risks. So that's what the next few rules are going to try and address, so you don't end up investing in a hyped up bubble. Number 4 is to find financially strong businesses, because you might find a company that's experiencing rapid growth, but you have to make sure that that growth is sustainable, even if it comes across a future hurdle, be that things like economic slowdowns or increased competition. And there are 3 metrics that can help us find financially strong businesses very easily. Number 1 is cash flow, which simply describes how much cash is coming into the business versus going out of it. If you want to lower your investment risk, find companies with positive cash flow, which simply means that they bring more money in than goes out. Number 2 is debt to equity, because high levels of debt can absolutely cripple even very good businesses. And a good way to easily understand a company's debt situation is through the debt to equity ratio. This shows the amount of debt versus the total assets minus the total liabilities. You generally want this number to be close to or lower than 1, but that can change depending on the company's sector. So just remember to check. We'll talk more about that later. Number 3 is return on equity, or ROE, which measures a company's profit as a percentage of the total equity in the company. It's basically a measure of how good a company is at forging a profit based on the resources it has to work with. For example, if a company's profit equals $1 million and the total equity of the company is $10 million, then its return on equity is 10%. Typically, an ROE above 15% is considered good, but again, that will change depending on which sector you're looking at. Number 5 is to value the share price appropriately. The point here is if you do find companies that have experienced high revenue growth and are financially strong, then it's very unlikely that any of the traditional value metrics are going to be low. The market will have noticed these stocks, so they're not going to have super low price to earnings or price to book ratios, which is totally fine. Remember, we're looking for businesses that are likely to grow, not ones that are super undervalued. But we do still need a way to value the share price appropriately. And one of the best ways to do that is to use a sort of elevated version of the PE ratio, which is called the PEG ratio. Made popular by the legendary investor Peter Lynch, the PEG stands for price earnings to growth. Basically, it takes the traditional price to earnings ratio and then compares that to the expected growth in earnings. Anything below a PEG ratio of 1 is thought to be undervalued, but anything at around a PEG of 1.5 would represent a pretty fair valuation. Our members of Investor52.com will probably recognise all of these metrics as part of the criteria that make up our lower risk and balanced risk stock lists. Number 6 is to remember that different sectors have different averages. All these metrics I've talked about can vary on average depending on which sector the business operates in, so it's always important to research industry-specific averages. Ideally as up to date as possible too, because the macroeconomic situation can affect them. A return on equity of 15% might not be that impressive in a boom market, but it could be very impressive in a recession where other businesses in the same sector are struggling. On Investor52.com, our dashboard automatically ranks every company metric against every other business in that sector every single day, and it tells you if it's low or high compared to its competitors. But you can also do this to an extent by looking at historical sector reports. However you do it, it's vital to take differences between sectors into consideration if you're going to be using financial metrics for investing in stocks, which you probably should. Number 7 is to relax about macroeconomics. Macroeconomics being the state of the economy as a whole. The media generally likes to prey on people's fear. Most news reports and articles will be about something negative, whether it's economics or celebrity gossip. It's just the way our brains seem to work, unfortunately. We seek out these negative stories, and so that's what the media feeds us. And if you listen to it too much, you think the economy and stock market were collapsing every other week. It's almost always exaggerated, and sometimes it's just total crap. To prove that point, here's a chart of gains and losses in bull and bear markets over the last 80 years. The difference is pretty stark periods of high growth always massively outperform the bearish periods. In fact, the average bull market lasts around 59 months with 169% gains, whereas bear markets only last around 10 months with 35% declines. The reality of investing, which no one really says, is that it's actually not that difficult. You're much more likely to win than you are to lose. This isn't like gambling at a casino where the odds are stacked against you. With investing, the odds are actually stacked in your favour. So don't focus on news reports saying that the market is at a new all-time high and it's just about to collapse. There is always opportunity. I invested in Nvidia earlier this year at a time when not only Nvidia was at an all-time high, but the market itself was at an all-time high, particularly tech stocks. And the global economy hasn't been doing particularly well in that time period either, but I'm up almost 50% on that investment in just 8 months. The point is, Nvidia was still a business with lots of potential to grow. It hit all the criteria we've already discussed in this video. So I didn't care about the macroeconomic situation. I was focusing on what the business itself could do, whilst taking into consideration this next rule. Number 8 is commit to the long game. The only way you can be comfortable with the previous step of ignoring macroeconomics is to only make investments you are committed to for the long term. The way I like to think about it is, when I buy a stock, would I be happy simply holding it for the next 10 years? Do I truly believe this business could double or triple over that next 10 years, or am I simply just buying it on impulse? This is a super important question because not only will it force you to make better decisions, but it also stop you from panicking down the road. If we do go into a recession or the company produces some poor quarterly results, it's a lot easier to handle if you're thinking about the next 10 years instead of the next 10 months or 10 weeks. Back in 2021-22, Meta had an horrendous share price crash of around 75%. I think it was always unjustified because Meta is one of the best run businesses in the world, in my opinion, and Mark Zuckerberg is one of the world's great innovators. But a lot of Meta investors panicked and sold at this point, which is a disastrous choice to make because since then the stock has risen over 500%. Someone with a short-term mindset would have sold that stock when it crashed, but someone thinking over a 10-year period would have waited. Try to approach investing as that second person. And to do that, you really have to understand this next point. Number 9, your stocks will crash. It doesn't matter if you manage to pick the best investment possible over the next 20 years. At some point, the share price of pretty much any company will crash to some extent. Share price increases are never, ever, ever linear, and people often don't mentally prepare themselves for a share price drop of 10, 20, even 50%. So when it does happen, and it will, they panic. Share price drops can be caused by a whole load of factors outside of the core fundamentals of the business. Interest rate changes, rotation into smaller cap stocks, market sentiment, all these things can cause markets to drop, even if nothing has changed with the actual business itself. Make sure you keep your focus on the fundamentals of the business. Is it still financially strong? Is the business still growing? These are the things that really matter. Often stocks can drop even after posting quarterly earnings report that beat expectations, purely because they didn't beat expectations by as much as some investors were hoping. But if you've based your investment decisions on the reality of the financial fundamentals rather than just hyped up guesswork, then these short-term drops in price really just don't matter. In fact, they're usually a good opportunity to buy more. Number 10, limit your diversification. It's very common advice to diversify your portfolio as a way of limiting your risk, but diversifying too much can actually bring a risk in of itself. If you diversify across, say, 20 stocks, you need to keep an eye on 20 stocks. You need to understand their metrics, you need to understand their products. For a home investor, it's a lot to keep track of, and it will likely mean you're not focused, and so you're very likely to make mistakes. I prefer a different approach which achieves the same low risk ambition. Focus in on a small selection of stocks you are extremely confident in and then diversify using an index fund. Let me show you what I do. My current portfolio consists of just 5 stocks, which allows me to easily keep track of them. But those 5 stocks only make up about 63% of my portfolio, The other 37% is invested in the Nasdaq 100, which is an index fund spread across the largest 100 stocks listed on the Nasdaq, the USA stock exchange for businesses in the tech sector. This approach allows me to diversify my portfolio and lower my risk, but it also still allows me to focus in on just those 5 individual stocks that I've chosen. Number 11 is be wary of equity. Now this one doesn't really get talked about by anyone, but it's actually really important. I mentioned equity earlier in this video because you can compare it to liabilities to help assess a company's debt position. Equity is basically a company's total value of its assets minus its total liabilities. So for example, if your assets are worth $100 million and your liabilities, which are your debts, are worth $80 million, then your equity is the $20 million difference. But there's something super important which hardly anyone talks about when it comes to assets, because one of those assets is a company's brand value. A company will literally assign a value to its brand. It's a dollar figure and it's put down in the books as an asset. For example, imagine Apple. As soon as a product is associated with Apple, the value of that product increases because of the reputation that the Apple brand has. And so the brand Apple in of itself is worth something, more than just the product. The brand in itself has value. But here's the issue you need to know about, and it's going to lead into my final rule. Brands can be overvalued. And when that happens, it can make their financial metrics appear much better than they actually are. And it's one of the most difficult things to spot. Here is a real life example. Back at the start of 2019, Kraft Heinz was seen by many as a good value investment. Even Warren Buffett had the company in his Berkshire Hathaway portfolio. It appeared to have reasonably low debt and it was trading at a fair to low price. Then in February 2019, they had a re-evaluation of their brand value. It turned out their customers didn't actually rate them that highly anymore, and their Kraft and Oscar Mayer brands decreased in value by $15.4 billion overnight. All of a sudden their asset value disappeared, and they went from being in a relatively low debt position to actually a very high debt position. It was a disastrous revelation and their share price plummeted. At its worst point, the stock collapsed by 53%, and it's still down 35% since 2019. Their brand was overvalued, and so it distorted their underlying financial metrics. But there is a very simple way to guard yourself against this risk, and it's my final rule. Number 12 is use the products. This rule isn't absolutely essential, and in some cases it might not be practical, but I much prefer to invest in companies where I use at least some of their products. For my last example, if you invested in Kraft Heinz in 2018 but didn't actually consume the product yourself, you'd really have to ask yourself, why am I investing in this company? I don't even like the product. The 5 stocks which I mentioned make up 53% of my portfolio. I'm a customer of all of them. And the day I choose to stop being a customer is an additional indicator that something might be wrong, and it's a really useful one. The video game industry is a really good example of this because their products get so heavily reviewed and critiqued. They live or die by the quality of the video games they make. Reputations in that industry can be made or lost in just a couple of years. Let me show you an example. Through the mid to late 2010s, Ubisoft's share price rocketed as they released hit after hit of innovative and fun games, but since their peak, it's absolutely plummeted almost 90%, and their brand reputation is on the floor. But someone who enjoyed their games would have seen this coming, because the big game releases they made during this late 2018 to 21 period just did not hit with their audience. It's hard to say exactly why, and everyone will have their own opinion, but the bottom line is their customers simply didn't think the games were as fun. Their product was getting worse. Something an investor who didn't play those games themselves wouldn't have noticed. It's not absolutely essential, but actually being a customer of the businesses you invest in gives you a direct indicator into the quality of the products they're offering to their customers and whether that quality changes. It can be incredibly useful.